Investor Intelligence provides general information only. You should consider seeking independent advice to see how this information relates to your unique circumstances. Please refer to the terms and conditions available at investorintelligence.com.au for more.
Welcome to this week's episode of Investor Intelligence, your weekly podcast on all things investment, hosted by me, Jacob Kearns. Today I'm joined by James Milic, financial advisor at Index Wealth, who specialises in personal risk and insurance. Hello, James.
Hello, Jacob.
So I want to start this conversation by shouting out a mutual friend of ours, Stephen Kwan. We had a conversation in preparation for this podcast, actually, about insurance, and he asked whether I was insured. I'm not. My car is insured, and he asked me to write down health, life, car, and house on a piece of paper and rate the importance. And obviously, life came first, car came last, and then I'm sure you can see where he's going with this. You know, why do you have your car insured but not your life? My argument was, when I die, I don't get the money, so, you know, why do I need life insurance? But obviously, that's not the case. And here with me is James. So tell me a little bit about your background and your role at Index Wealth.
Yeah, well, thanks for having me on the podcast, Jacob. So I am a financial planner at Index Wealth, and one of the key areas I specialise in is protecting investors who want to grow their wealth through property, and looking at ways and structures to make sure that throughout their journey, if something happens to them, still able to maintain the property portfolio.
Right. Let's break down each of the different insurances, and then we can maybe discuss what is most relevant to an investor versus maybe not so relevant. Or I'm guessing that would differ between case-to-case basis, right?
Yeah, obviously it depends a lot of what your situation and goals are. Speaking of structures just a moment ago, we usually set up some covers to make sure that their goals are protected. There are some complexities when it comes to, you know, what the covers are and how they work. So usually what I do is I'll do a short diagram to explain what each of them are. So obviously if you can't see it, it looks like a cross. And on the top left-hand quadrant, you've got something called life cover. And the way this one works is it pays out as a once-off payment, usually to family or loved ones. Most investors want to make sure that, hey, my long-term goal is to make sure they've got a principal place of residence paid off. So we'll look at ways to make sure that's covered. And of course, you might need some income to look after your family if you're not here. So you might set it up as like a once-off payment and then use that over the next 10 years. Or you might pay off some investment properties and use the rental income to look after your family if you're not here tomorrow. In the bottom right graph, there's one called income protection. And the way this one works, if you can't work, it'll give you regular income until you can go back to work. So for an investor, if you've got properties that might have a shortfall where you're receiving less rent than what your repayments are, you've obviously still got money coming in there to meet those shortfalls if you're not able to work.
Yeah.
If you've got a principal place residence, obviously there's money there to pay off your home debt.
Yeah.
So then, you know, you've got somewhere safe to live. If there's a period of time where you're not able to work, you're still able to maintain your properties, not be forced to sell them, obviously taking away from your long-term goals.
And when might income protection kick in for someone?
Yeah, if you're not able to work. So illness, injuries, you go to your doctor, they say, you know, Jacob, based on, you know, you can't talk and therefore you can't be on a podcast because of this injury that you've had, well, that'd be an income protection claim for.
And is it covered the same for everybody?
It depends, again, what your situation is. So obviously the amount of money that you'd be receiving if you couldn't work would be closely related to how much income you were earning before you were disabled.
Yeah.
So it depends on what your situation is.
Is there anything it doesn't cover?
Sometimes I get a lot of questions about, okay, if I'm made redundant, do I get income protection? But this one's just injury and illnesses. Okay. So we look at ways with clients to make sure that they are covered in times of redundancy. So that might be setting up a cash buffer to make sure that they've got money there for a certain amount of time, you know, based on what their occupation is. If it's a IT-based field, generally quite high demand, you might only need about 3 months of savings. You might have it in an offset to make sure periods of redundancy you still are covered. The next one happens in more serious circumstances. It's called TPD, or total and permanent disablement. Again, more serious circumstances, if you can't go back to work ever again, it'll pay off as a once-off. And most clients will have a long-term goal again where they want a principal place of residence paid off, a home to live in.
Yeah.
So we'll set this up to make sure that they can't work ever again. They've got their own home that's been paid off. In the meantime, you'll also still be receiving your regular income protection payments from here. So for an investor, again, if there's shortfalls in your investment property portfolio, you'll be able to meet that with the income that's coming in. And of course, you've still got money left over to look after your living expenses and to look after yourself and the family.
Okay, so just clarify for me, what's the difference between the total and permanent disability and the income protection?
Yeah, good question. So as you can probably see, they're both related to your ability to work, whereas income protection will cover in the event of potentially a temporary disablement. Again, if we come back to if you lost your voice and it's a 6-month kind of thing, it'll pay that regular income for 6 months.
Yeah.
If you're getting better and it looks like you'll be able to return back to work, then total and permanent disablement won't pay out because it's not permanent. But if, touch wood, but if something happened to your voice totally and you can't speak anymore, then you'd be claiming on both.
So is this right? So income protection is just a temporary month-by-month basis sort of thing, whereas total and permanent is permanent?
Yeah, pretty much.
Yeah.
Income's temporary and can also be permanent as well. So, obviously, if something happened to me tomorrow and I've got my total permanent disablement to pay off a debt-free house, I'll still need income to look after living expenses and property shortfalls as well.
Yeah. So is total and permanent a once-off payment?
Yeah. Similar to life cover. Had just that once off.
Okay.
You can't work ever again. Here's that lump sum.
So would you need both?
Again, it's really closely related to, okay, what does your situation look like? What assets do you have? What do you want covered? So what are your goals?
Yeah.
And based on your situation, then we'll look at a suitable structure to have the amounts, which ones we might need to cover which goals.
Yeah. Okay.
Yeah.
Tell me, what is the last one?
So the last one is one called trauma.
Yeah.
And what we've found with many clients, it's not as well known as these other 3 ones that I've been talking about, but based on statistics, it's the second most claimed upon cover, second to income protection. The way it's a little bit different from income protection and TPD is trauma pays out if you get diagnosed with a serious medical illness, whereas income protection and TPD pay out if you can't work or you're related to your ability to work.
Yeah.
So really common serious illnesses is like your strokes, heart attacks and cancers. And often with these serious illnesses is that you don't necessarily need to take time off work if you get diagnosed with one of these. I just overheard a conversation recently with a conveyancer, and he was explaining a story how he was just in the hospital 2 weeks ago because he had a heart attack and as a result had to have a double or triple bypass, and he was in the intensive care unit for about 5 days. Now, just looking at this guy, you can see he's clearly unwell, even before he said anything. Now, he was back at work, already working, only 2 weeks later after being out of the intensive care unit. And what comes to my mind is he probably does have to work to pay off his mortgage, look after the family, put food on the table. But if he had a trauma policy in place, he'd have that payout there. It would allow him to say, I'm going to take a bit of time off work. I'm going to spend time with my friends and family. If he was a really avid property investor, he might even make the most out of that situation and use that payout to put a deposit down for another property.
No, it's definitely a confronting situation and it can happen to anyone.
Of course, yes.
Yeah. As you said, for just a small percent of your salary, it's very helpful to know that you're covered in situations like that.
Yeah, it's a small investment, small sacrifice to make sure that your long-term goals are protected. And if your injury illness gets worse, that's when you start receiving the regular income, can't go back to work ever again. That TPD pays out, pay off the house. No longer here looking after the family with a life cover.
That makes a lot of sense, and it's helpful to paint a situation where having a life event like that, you're not going to want to go back to work, but as you said, he's still got to pay the bills and everything. So
yeah, that's right. It fills that gap because income protection, it's all related to ability to work, but you might not necessarily be off work. It's a life event like that happens, like a stroke or a heart attack.
Yeah. Do you find with your clients that you start working with, maybe they've avoided it because they don't want to talk about it or they underestimate how important this is?
Yeah, it's a good question. So I do find a little bit of that. It's a combination of two things. So the first one is, yes, it is a little bit dark. It's a bit confronting. It's a bit scary, which means that you can't avoid thinking about it. But the second one is that when you do some research, you'll probably jump online and look up, life insurance or what type of covers there are. And there's so much information out there. It's so hard to make sense of it all. What's important, what's not important, what's relevant to my situation. And then even after you've gathered all that information, how do I go about applying it? Which insurance provider do I pick? What's best for my situation? And, as a result, it leaves you throwing your hands in the air and saying, stuff this, and not thinking about it anymore.
Yeah, too hard.
Yeah.
Yeah.
And I don't blame people that do that. You're obviously busy with day-to-day. You've got a job. You might have kids at home. You got your investment properties. You might need maintenance done. It's hard to think about, all right, what should I do to set this up? How do I go about this?
And I guess, especially if you're young, you don't really think that something like that is going to happen to you. It's easy to sort of brush away until something like that does happen and you sort of think, shit, maybe I should have got myself covered.
Yeah.
And so people often have in their superannuation already packages bundled in with their super. Is there a difference between the insurances that you would source for your clients and what they might already have in their super?
Yeah, that's a good question. And it's interesting that a lot of people don't really realise that they already have insurances bundled into their superannuation. Now, when we do a little bit of research, okay, what do we currently have in our superannuation? Well, we usually find there's 3 key limitations with the ones that you already have. So the first one is that you usually find the levels of cover that are automatically assigned to you aren't suitable for anyone, let alone an investor.
Okay.
So what I mean by this is if you needed to claim on any of these covers, then it wouldn't really be enough to cover even just your living expenses, let alone, your repayments on your property. So it can leave you in situations where, you're still in a really tough situation if you need to make a claim.
Yeah.
The second one is that the actual covers that you have in your superannuation can be limited. So if you're thinking back to the 4 types of covers we were talking about before, trauma won't be found in your superannuation, as well as the actual other covers as well. The policies are limited, which can, as a result, be harder to claim on. And then lastly, if you go and you're looking at your superannuation and thinking, well, these covers aren't suitable, the amount, so let's make some adjustments to it. And, you contact your superannuation company to make those adjustments. You might find that you're not getting the best outcomes for your situation, and it might lead you to premiums not being competitively priced and compared to other providers, but also might leave you with a policy that you can't even claim on based on what your situation is.
Okay. Something that a colleague said to me is that it's not necessarily paid out to you. Is that correct? It might go into your super?
Yeah, that's right. So again, it comes back to how the policies are structured. What you usually find with your policies inside your superannuation is that, for example, the total and permanent disablement, so if you can't go back to work ever again, the way it pays out is the super company will end up paying into, your insurance provider will end up paying into your superannuation provider.
Right.
And in order for the superannuation to release the money into yourself or into your bank account, it has to meet certain legislation requirements. And you might not necessarily always meet those requirements. And as a result, your payout can get stuck inside superannuation.
Okay. So what's the process of getting that out?
Yep. So once you've made the claim, then you just have to navigate the legislation in order to prove that, hey, I am eligible to take this out. But if your situation doesn't meet that, you might get stuck inside superannuation. And obviously it's no good there because you need to pay for your properties. You might need to pay for, your living expenses. No good stuck inside superannuation.
Yeah, exactly. No, I can definitely see how that's not ideal. So initially when you start working with a client and you're talking about their goals, their current situation, what's the process you take in really formulating a plan that's suitable for them?
Yep, good question. So it's really important to understand what our clients' goals are and what it is that they want protected. Yep. So for an investor, they might be saying, James, my long-term goal is to have 15 investment properties paid off in the next 20 years. Now, when we're sitting down with this client, we might say, all right, if something happens to you, how much of that goal do you want to have achieved? Do you want to say, if you can't work ever again, do you want to have maybe 10 properties, 12 properties? And what we'll do is we'll work backwards from there. So then we'll look, okay, what do we currently have in place? What are the structures that we have? What covers do we have? What assets do we have as well? And if there's any gaps, we'll look at ways to address that. And there might be some covers involved to meet that.
So how much does age come into play?
Yep. So if you're looking at someone between their 20s and 40s, just age alone isn't enough of a picture to understand what their covers might look like. Generally speaking, though, if you're speaking to someone in their 20s, if they're really driven in growing their investment property portfolio, they might have 1 or 2 properties with the long-term goal of having, 6 or 7. Now, with growing out those 6 to 7, a lot of how they're going to be purchasing those properties is through income, through working.
Yeah.
And for this particular client, it might be more important to have income protected to ensure that if they're not able to work, they can still continue to save, build up deposits, and effectively purchase those houses.
Yeah.
Whereas, if you're looking at someone in their 40s, they might be a little bit more established. They might already have some investment properties. They might also have a family as well. So what their covers might look like is family house, might have a bigger debt. So you might have more life cover in place to make sure that they're not here, then there's a house for the family.
Yeah.
If they've already got investment properties, then you might say, okay, let's look at potentially selling some of these properties in the event you're not here and make some reductions in some of your covers. So again, it just depends on what your situation is.
Yeah, and it's interesting you brought the first example up too, because the income protection isn't there just to maintain the current lifestyle that you've got. As you said, you can still save for deposits and still keep investing if something were to happen, which is interesting.
Yeah,
I
definitely.
didn't realize
Absolutely.
you could do that. Yeah.
Because, if you might be saving for, 6 months, 12 months, 2 years, and if you're off work for 6 months, well, there's your savings gone. You've just lost 2 years of your investment.
So if anyone has ever watched daytime TV, there's a whole bunch of infomercials in there. And I actually remember always watching these at my grandmother's house on like the Today Show or something where, there'd be a bad actress sitting there talking about life insurance. What's the difference between a company like Real Life Insurance compared to what it is that you source for your clients?
Yep. So it serves a purpose, which is really good. All covers end up serving a purpose. Now, with these type of real life insurance, one of the major limitations is that they can only provide general advice when you call them up to set up your covers. Again, if your situation suits that, you might just have a really small amount of debt and not too much, goals. You might not be an investor. Then sure, real life insurance might be the best fit for you. But based on experience, if you're an investor or if you have even just a little bit of debt, then they really aren't suitable. So one key example is, throughout what I do, I give personalized advice, and throughout personalized advice, I can structure premiums through your superannuation. Now, kind of comparing that to real life insurance can only be funded out of pocket. Any premiums that you pay will be paid out of pocket. How that impacts the investor is that you're paying premiums out of pocket. It's going to affect your ability to borrow money from the bank. Yeah. So if you've got some growth in your properties and you want to do an equity release and purchase another property, banks are going to look at how much your expenses are. And obviously, premiums are going to form a part of that and might impact your ability to purchase more properties. And if you want to make sure you're getting a better interest rate, ability to refinance might be impacted from these premiums.
Yeah.
But again, because I give personalised advice, I can look at ways to structure those premiums to be paid out of your superannuation if that's suitable for you. And with the general advice, it's quite a complex field. And just to kind of put it into perspective, in Australia, there's only about 15,000 advisors who can give personalised advice.
Okay.
And of those 15,000, there's only 600 that are setting up new policies for their clients. So it is a very complex field, and it's really important that you're getting the right advice to make sure that you're getting a personalised plan that suits your investment goals.
Yeah, and it does sound very complex, when you start adding more and more properties into the mix. I can see how, general advice just isn't going to suit most investors out there.
When you're speaking to someone that can only give general advice, they can't consider what your situation is and provide the solution for that. They can only say, okay, similar to how we went before, this is the life cover, this is what TPD is, what's what income protection, this is what trauma is. Now, Jacob, what do you want? It's like, well, you need a bit of guidance to understand, what do I need?
And if you're brand new to all these things, you're not going to know what you need unless you have someone that you can talk to and give advice, especially when you're growing a portfolio.
Yeah, that's right. Really understanding, okay, what are your goals are, and, setting up the right structures to make sure that you're meeting those goals, really aligning the two.
I can definitely see the value in, getting some personalized advice compared to, the general advice you might get from a company such as Real Life Insurance. What's the pricing difference?
A lot of people will hear personalized advice and they'll think that it's going to cost them a lot more, especially compared to something like Real Life Insurance. But what we find is that it's still very, very competitively priced compared to something like Real Life Insurance.
So you mentioned when you're paying the premiums, it sometimes will have an effect on your borrowing capacity. How would you go about balancing that between wanting to stay protected? Is it expensive?
Obviously, how much it's going to cost is going to be a big consideration.
Yeah.
There's no point paying tens of thousands of dollars for covers and not have anything to show for it. So that's why it's really important that you have the right philosophy to make sure that, what you have is actually affordable. And what we found is working with over many clients, setting up over 3,000 policies, the best way to structure your premiums or affordability is to work off a small percentage of your income and sacrificing that to make sure that if something unexpected occurs throughout your property journey, then you can actually meet your goals. And what's oftentimes forgotten is how expensive it can be if you can't work. So if you pick an average Australian, say 40 years old and earning average income of about $90,000 and wanting to retire at 65 years old. So obviously about 25 years left in the workforce. Now over those 25 years, just on income alone, adjusted for inflation, it's a $5 million asset that this client or this investor is potentially going to be earning. So making sure that's protected is obviously going to be really expensive and really important to have covered. But what also is tied into that is, okay, this 4-year-old might have investment properties that might need to be sold if he can't work in order to look after himself and his family.
Yeah.
So you've got that loss of income there. You've obviously got that loss of potential investments. So it's just sacrificing a small amount to make sure you're still able to meet those goals.
Yeah, I want to ask you 2 questions on that. Firstly, can you dig a little bit deeper in the way you spoke about that $5 million as if it's an asset that you already have? So it's interesting that you sort of discuss it in that way, acting like you have it now, which is really useful to sort of think about because you will have that.
Yeah, absolutely.
As time goes on.
Definitely. And like you've got so many different investments tied into the income that you're going to be earning. So, you take out a loan for a house to purchase a property on the basis that you're going to continue to work and be able to pay back the bank. So then obviously if your income stops, then you're not going to be able to pay back the bank. And obviously you'll probably need to sell it.
Yeah, so it's not just the income that you are losing by not being able to work, it's opportunity costs of what you could do with that income if you had it.
Absolutely.
By, not being able to invest.
Yeah, definitely. For sure.
That's interesting. And what is the percent that you typically recommend people dedicate to this based on their income?
Yeah, of course, it'll depend what your situation is.
Yeah.
We usually work off a percentage of about 2 to 5%.
Okay.
But again, it'll depend on what your situation is.
Yeah, I think it's helpful to think of it as a percentage too, rather than just a number, because giving away 2 to 5% of your income does seem like a small price to pay, knowing that you've got that protection in the event of the person you're talking about before who had a heart attack. Obviously something that you're not going to be able to foresee, but it's comfortable knowing that you're protected if something like that does happen to you.
Yeah, for sure, because you can be doing the best investment decisions, building your portfolio, and you're just protecting it against what's out of your control.
If someone's listening to this and they can see the value in getting themselves insured, what does the process look like and what role do you play in that?
So, of course, this is the most important part of the whole process. It's the reason why we set up these covers in the first place. So it's really important that you're getting the right guidance. And at the end of the day, it's a really vulnerable time as well. So, what the right guidance, why that's important, is that when you're making a claim, you're going to need to supply evidence, supply information to the insurance company. You're going to need to select which covers you're actually claiming on and the specific definitions within them. Especially important if you've got a complex case. And I was just recently working with one of my clients who unfortunately had some complications with her pregnancy and had some pretty severe back and pelvic pain as a result. And she was then off work for much longer than expected in a maternity leave. And why this is really complicated is that insurance providers usually don't pay out if you just have a normal pregnancy. So we have to be really clear, gather the right information, guide our client to make sure that she's going to the doctor and asking for specific information, specific doctor's opinion, collecting all that information, then submitting it off to the insurance company so we can show them, hey, what our client is experiencing here isn't something normal. And it's actually complicated. And with that, to make sure you get the best possible outcomes. And actually, funny enough, that was approved on Tuesday this week. Really happy win about that one.
Yeah, that's great. And you wouldn't know what questions to ask if you weren't working with someone such as yourself as well.
Yeah. Oftentimes, you call up the insurance company and they'll say supply evidence, which is fine. But it's, ideal to have some understanding, or it's important to have some understanding of what that evidence looks like in order to make sure you're minimising the time from the time you submitted the claim to actually getting the money, less back and forth. And Jacob, because it's obviously quite a vulnerable time, if you're needing to claim on these covers, you're probably in a pretty tight spot. So it's really beneficial to be able to just speak to someone that's familiar, who's helped you set up these policies, and really understand what the purpose of it all is. And that way you're not speaking to somebody on the other end of the phone, like an agent from the insurance company who doesn't really know your situation. Yeah,
a bit more of a personal approach. Is it hard? Obviously, the insurance companies are incentivized to minimize the payments they're giving out. And I have heard, some situations where something happens to someone and they're not covered, what's the comparison between working with someone like you in terms of actually getting their insurance payout as opposed to maybe working with themselves and not being able to get that?
Yeah. So it's a good question. So there's two main parts. The first part is to make sure that when you're setting it up, it's actually suitable and it's actually reliable and it's covering you for what you want to be covered for. So even circling back to that example that you gave before where the payments potentially getting stuck inside your superannuation, well, it's really important before the policies are set up, you're avoiding that, where it can get paid out directly to you. But on the other side of it is making sure that at the time of claim, you know which part of the policy you're actually claiming on and how to supply evidence to meet that.
Yeah.
Those are the two reasons why sometimes you hear that policies aren't being paid out. It's either usually because one of those two.
Yeah. Yeah,
two factors.
That makes sense. So definitely doing the work, doing the research and working with someone such as yourself in the beginning when setting them up to make sure you are covered for exactly what you'd need.
Yeah, that's right. Getting the right guidance along the way, for sure.
Yeah.
So then, after you've sat down and you realise that, okay, I need to make sure that I've got my coverage reviews, how would I go about it? So what we found, there's 4 key stages that you should go through when you're reviewing your covers. The first one is, again, understanding what your goals are, what your needs are, what do you want to have paid off as an investor if you're not here, or how much money do I need to service my properties? From there, you look at, okay, these are the covers that are available. Which one of these do I need? Which ones are suitable to meet my goals that I've just set out for myself? From there, we need to look at, okay, how do I structure this? What's the best way? And when I say structure, I'm talking about, do I want to pay all these out of pocket or do I want to pay it all out of superannuation? Or based on my situation, is it best to have a combination of through your superannuation and out of pocket as well? From there, after you've got your strategy in place, what types of covers you want, what levels of cover you want within them, then it comes to, okay, which of the insurance providers in the market would suit me the best? And what's really important to do here is you contact the insurance providers and you discuss your situation with them, your health circumstances, what you do for work, everything about your situation, and make sure that you're getting the best possible outcome during the negotiations. From there, you look at, okay, which one of these also has the most competitive pricing based on, what your needs are. And then, of course, submitting it and make sure it goes into place as you previously negotiated. So you're not experiencing you get your offer and it's got some lower back exclusion, which wasn't previously negotiated with.
Yeah.
And of course, it's important to review it as your circumstances change.
Yeah. And how often should you be reviewing your insurance?
Working with many clients, what we found every 2 years is a really good point in time to review your covers, where there's enough changes happened in your situation where it's worthwhile reviewing, but it's not limited to 2 years. So, if you have a big change in your situation, Jacob, you might have a kid or, you might have just purchased 6 investment properties and you want to make sure that you've got the structures in place to meet that, and what you currently have, your situation looks quite different now.
Yeah.
It's great to review it to make sure that you're covering your new goals.
Yeah, okay. So every 2 years roughly, or if a life event happens, it's a good idea to look at it.
Yeah, for sure.
Yeah. Is there any sort of key advice you'd like, or the biggest takeaway our audience should have from this conversation?
The biggest takeaway is that it's really important, and the first thing is, setting up your goals through investing, building out your property portfolio, but also to make sure that you've got the right structures in place to ensure that if something happened that was out of your control throughout your property journey, you're still able to meet your goals of, purchasing property.
At what stage should someone be looking at insurance? Is it everybody or?
Yep. So as you said, unfortunately, serious illnesses and injuries can happen to anybody.
Yeah.
Now, a good time to review it is when you are setting up your goals and when you're working towards your goals, because then, if you've really got something to lose, because, you've got your life set out, you got plans in place. And from there, it's really important to look at ways to make sure you're still able to meet that if something occurs that's out of your control.
Yeah. Well, James, it's been great having you. Definitely opened my eyes about how important all this stuff is. If any of our listeners want to get in contact with you or your team at Index Wealth, we'll be sure to include the link in the show notes.
Fantastic.
But I do have 2 final questions for you. Do you have a favourite book?
Favourite book, yes. So I was prepared just before you asked this question now. So favourite book or good book to read, Luke Harris's Let's Get Real. No, but seriously, it's a really motivating book. It really helps you understand, all right, how do I set goals and really work towards it? And again, motivates you to reach that. But probably one of my favorite books is Robert Kiyosaki's Rich Dad Poor Dad. He talks a lot about building your investments and living off the investment return rather than, working and just using all your income to live off. And what I found is that really resonated with me and the philosophies that I have.
Yeah, and I actually haven't read Rich Dad Poor Dad, but I've read his other book, Cash Flow Quadrant, and you're the second person to say that's their favourite book. Stephen actually last week said that was his favourite book as well, so I'll have to go back and read that one.
Definitely, good read.
And yeah, final question, what are you excited about for the future?
So there's a few things I'm excited for. Firstly, it looks like Blues are going to make finals, which I think is about the first time in almost 10 years. But other than that, as I mentioned earlier on, there's only about 600 advisors who specialise in what I do. So I'm really excited for the new generation of advisors coming in and seeing where the industry goes.
Yeah.
But then, on the back of also COVID being a thing of the past, which everybody's extremely grateful for, borders opening up and new migrants coming into Australia. And what that means is they're going to need somewhere to live. And it's a massive opportunity for, residential investors of property to really capture that growth.
Yeah, that's something that we talk about to no end on this podcast. There's so many exciting things happening in the property industry, and it's sort of a shame to see people deterred by such short-term things such as interest rates. But if you look at the history of property and the pieces together of that supply and demand function going into the future, it is an exciting time to be an investor. And it sounds like you're in a really unique position. As you said, only 600 advisors doing a similar thing to you. I imagine it's pretty rewarding working with people on this level. And obviously you don't want these things to happen, but it's helpful to know that your clients are secure when and if these things do happen to them.
Absolutely. It's nothing better than, being able to deliver the news to your clients that they've got money coming in when they need it.
Yeah, it turns a potential nightmare into something that's a lot more bearable.
Yeah, it goes from tears of sadness to tears of joy.
Well, thanks for your time again, James, and I look forward to having you back on.
Thanks for having me back. Appreciate it.
If you found this episode or any of our episodes helpful, please make sure to share and leave a rating to help us reach more people on their investing journeys. And of course, subscribe to be notified when new episodes drop. Make sure to follow the podcast on Instagram at Investor Intelligence Podcast. You can find links to our other socials in the show notes, including a link to the Property Mentors weekly blog. If you're ready to get your property portfolio in shape for financial freedom, check out Luke's latest book, Property Fit. You can get yourself a copy at www.propertyfitbook.com.au.